So there are two main things that Wall Street analysts consistently get wrong. And I'm going to tell you both of those things in these videos and what some of the implications are of these mistakes. I also want to apologize for a little bit of the sterile background behind me. I'm on the go this week, so this is what we're working with, and we're going to keep it moving. So quickly, I just want to talk about the difference between top-down investing and bottom-up investing. We actually have a video on this that I'll have pop up in one of the corners here that you can watch in more depth, or you can pause the video here to read through this table, as I'm not going to go through sort of box by box. But it is important for this video to have a baseline understanding. So top-down investing, that's how we approach markets here at the Macro Institute. That's how we break things down and talk about things. We're basically starting at the big picture and working our way down. So that's what top-down. We're starting at the economy. We're then going down to sectors that are in favor during the specific economic backdrop. And then we're looking for companies that have specific factors that do well during this macro backdrop. On the other side, you have bottom-up investing, which care mostly about individual companies. So a lot of the Wall Street earnings reports that you read, this is this type of research, right? So they're worried about the company fundamentals. They're talking about revenues, earnings, maybe a little bit about their competitive advantage. You might get a little bit in these reports about sort of macro-y things, but for the most part, it's very, very specific to the individual company that they are covering. So we're mostly going to talk about bottom-up investing, or when I say Wall Street analysts, I'm mostly talking about those individual company reports. So mistake number one, Wall Street is too optimistic. So we did an analysis over a couple decades, and we looked at the different ratings of companies across Wall Street coverage. And we found that on average, around 70% of stocks at any given time were rated as a buy. And now that doesn't mean 30% were rated as a sell. 30% were actually rated as a hold. And a little under 1% were rated as a sell. So now this might make sense if the vast majority of companies perform really, really well. However, during that same period of time that we did this analysis, we found that around 55% of individual companies on a given year underperformed the S&P 500. So there's a mismatch here, right? Where 70% of the companies are being rated as buys, but 55% of the companies are actually underperforming the index. Now, there's a few reasons for why this happens. Probably the most famous and most nefarious reason has to do with conflicts of interest. I'm not going to say that's the only reason why this happens, but I do think it is a big one. And basically what happens is if there's a company that's publicly traded and they're looking to spin out a division or acquire a company or any type of big transaction, they're going to use an investment bank to do that. And when they're considering different investment banks to use, what these research firms and banks were worried about is that if their research department has a sell rating on that company and another bank has a buy rating, then it's more likely that they're going to go to the bank that has the buy rating and have them do the transaction for them. So that's obviously big business for them doing these transactions. So there was a concern that if you had sell ratings on certain companies, they wouldn't bring their business to that bank. Now, there's been a few things that have been done to try to mitigate this, but as you can see, nothing has really changed. There is a long-running thing here where very few stocks ever get a sell rating. And what that means is it really does not help investors identify stocks to avoid. So reading these earnings coverages does not help investors avoid portfolio torpedoes. And we've done a lot of analysis on portfolio torpedoes, and simply avoiding some of the worst performing companies within a given index does it just as much to boost return than picking the right winners. So avoiding the losers is just as important as picking the winners. And this type of research does not help you do that, right? It honestly doesn't even help you pick the winners either, because if everything is rated as a buy, or 70% of things are rated as a buy, then being rated as a buy has sort of lost its meaning, right? So if it doesn't help you avoid portfolio torpedoes, right, because it's not telling you stocks that are not in favor, because basically no stocks get a sell rating. And then on the flip side, it doesn't even really help you pick the winners because a buy rating doesn't mean as much, right? If we saw a more equal distribution of buys, holds, and sells, that would have more meaning and be helpful. But right now, these ratings don't really mean much for investors. Mistake number 2. Wall Street focuses mainly on earnings and not enough on price multiples. So as you can see here, there is almost a linear relationship between analyst earnings revisions and analyst price target revisions. Ideally, these two things would be anticipatory. However, this tight relationship suggests that analyst recommendations mostly just incorporate earnings and have very few assumptions about stock multiples. So if they were really considering the stock multiple aspect of a return, right? So if you think about price or a price target, there's two components. There's the projected earnings and there's the projected price multiple. Normally we use PE ratios. So there's two components. If these analysts were really considering the stock multiple component, this tight of a linear relationship would not exist. So what this basically tells us is that when earnings change, so when forecasted earnings change, they're changing their price target. Simple as that. They are not really working through any sort of analysis or deep analysis on what should the market multiple be, should the market multiple be changed. It's really just a hyper focus on earnings. What you do see is that PE ratios, the market PE ratios in particular, are extremely influential in this research. So buy ratings from Wall Street analysts tend to ebb and flow with the macroeconomy and the resulting valuation environment. Said differently, analysts tend to upgrade stocks when PEs move lower, almost irrespective of what is happening at the time. I think in large part this is due to the value investing's legacy for how long that value investing outperformed. But basically what this inverse relationship means between buy ratings and the S&P 500's PE is that when the PE moves lower, we see buy ratings go up. And that's just because analysts are saying these companies or the market is getting cheaper. They're not thinking through whether or not it should be getting cheaper, right? There could be great reasons for why a specific company's multiple is contracting. And on the flip side, when multiples move higher, you typically see buy ratings decrease. And again, there is very little thought as to whether multiple expansion is appropriate at this time or why multiple expansion is happening at that time. So there's this big component that Wall Street analysts being very zoomed in on earnings misses, and it's half of the equation. As you can see here, sometimes multiple expansion or contraction is a huge driver of a given year's earnings, a given year's returns. Earnings are the other factor. So if you look at a year like 1986, all the way on the left, multiple expansion or contraction was the main driver of S&P 500 performance that year. And on the flip side, if you look at a year like 2001, earnings was the main driver. So investors need to be cognizant of the factors driving equity market returns. At times, it can be largely driven by multiples or valuation. And at other times, it can be mostly driven by earnings. So the macro backdrop is going to play a huge role in this delineation. And it's just not something you're getting from traditional bottom-up research, as they are mainly focused on earnings and they almost completely ignore the multiples part. So just to recap the two mistakes. Mistake number 1, Wall Street analysts are far too optimistic. Around 70% of stocks at any given time are rated as a buy, despite most of the time more than half of the individual names underperforming the index. And then number 2, Wall Street analysts are too focused on earnings and do not spend enough time considering market multiples. That's what I'm going to leave you here today. I hope you enjoyed the video. I hope you have a great week. and I will see you here next Monday with another educational video.